Hi students, welcome back. This is my ABM224 class, accounting, managerial accounting for Cal Poly Pomona. So my agriculture students, take a look. So today we're focusing on chapter 6. Chapter 6 is all about inventory, as we talked about before. Inventory on our income statements is considered to be a current asset. I'm sorry, on our balance sheet is considered to be a current asset, but our inventory is also allocated. So this entire chapter, chapter 6, is to figure out what are our three types of inventory that a raw material supplier, a manufacturer, and a retailer would probably be taking. How do we count that inventory? Utilizing periodic and perpetual inventory systems, but specifically by utilizing periodic, which is a cycle count, hand picking and hand counting, we would use LIFO or FIFO. So I'm going to teach you all of that today, plus some ratios. So let's get started. There's three types of inventories that most manufacturers, raw ingredient suppliers would also use as well. So the first type is called raw material. The second one would be work in progress, which would be known as WIP, which you'd only see work in progress usually at a manufacturer's level specifically. So think of WIP as like a bullet, like, right? So the idea of a WIP is specifically where it is product that's taken from the raw inventory, brought into the production line, and being ready to make, like a pair of pants, right? So if we were to produce a pair of pants, specifically a pair of jeans, and we would sew one side of the pair of pants, and we had to stop production for the day, we couldn't count that as raw inventory. That inventory has been pulled with a pack sheet specifically to tell you how much raw materials is going to be ordered to produce this item, specifically be brought to the line. The line would already be adding, as we saw in the cost accounting in chapter 5, would be adding labor and packaging in order for it to be a finished good. So most manufacturers and suppliers and retailers, they really care more about the finished good inventory, but definitely keep an eye on the raw and the WIP, because especially if they're in a produce-like environment or company specifically, then the work in progress makes a big difference because they have short shelf life. So they don't want that product to expire because of the already invested assets that they've already invested in this product specifically. So the third one that we see a lot is finished good inventory. The finished good inventory is product that's ready to go to the retailer at any given notice. Those are products that already have manufacturing labor in it, it already has packaging in it, and it's ready to go. It's a sold good. So we count inventory by two ways. One is called perpetual, and the second is called periodic. In this example, periodic, I got a little hand up there because periodic inventory is usually taken by the end of the month or once a year, depending upon who wants that inventory to seriously be taken. Now, periodic inventory is the most important specifically because it's hand counted, right? You see it, you touch it, you know it physically exists. That is the inventory that we like to hold on to because we know that if we see it, we feel it, it exists. And that would be the value that we would add. The next part is the perpetual inventory. So the perpetual inventory is a computerized inventory system. And what that does is, let's say that in order for inventory to be loaded to the system, it would have to come from the receiving dock. So a truck would back into the receiving dock in the back warehouse. You'd have a receiving manager that would be there looking for that bill of lading. So they'd have a bill of lading, which is like a receipt of the purchase order or sales order that they have received. They would take the bill of lading, they would walk around the pallet to make sure that all of the UPCs and the quantities match. The reason that they want to make sure that the quantities match is because they want to make sure that the truck didn't short them product that they were expecting. If they do have product that they are expecting that was shorted, then they can reject the entire load. But let's say if the bill of lading matches the product that's on that pallet or in that specific truck, so it could be a whole truckload versus an LTL order, which would be one pallet specific that's being dropped off for that store. The pallet would be then taken off the truck as long as it was approved. It would go to be taken down. We would unpack the pallet specifically, it's called a teardown, and then we would take all those items, make sure they're accounted for, scan each UPC in, and put in a quantity into our inventory system for perpetual inventory. So perpetual inventory means that it's a computerized system, so the receiving dock would increase the number of units that they actually received, and then it would go into the warehouse to be stored until we would have pickers. So later that night, if you're a retailer, we'd probably have pickers that would come to replenish the stock on the store shelf. Specifically speaking, we would go ahead and have those people come and pick up the item and physically put it on the store shelf at night. Now, how does the inventory get depleted from a perpetual system? Well, that's easy. What happens is when customers come in and purchase that item, they'll take it to the till or the checkout counter. They would scan it, they'd pay with their card or cash, and as soon as that receipt has been taken and the transaction is then complete, the perpetual inventory system would then show a depletion of the amount of units that that person purchased for that item. When the inventory per SKU gets down to a certain level, the computerized perpetual inventory system is set specifically to send an EDI order, which is known as an electronic document. So instead of having someone actually handwrite a lot of our place orders, the computer will go ahead and send it directly to the distribution warehouse center or the manufacturer specifically to place a reorder for that item. So they're never out of stock. So that's how perpetual works. The issue we have with perpetual inventory systems, though, is that perpetual is a computerized system, right? So computers can't tell if something was stolen, if it's missing. It just knows from what the information with what we put in when we receive the item in the dock area versus when it's actually being purchased. So in a retailer's area, one of the biggest issues with perpetual inventory systems is sometimes if they have less than 3 or 4 items or units specifically, you probably don't have it. One of the reasons for that is because your employees are your number one biggest thieves. So maybe an employee stole it, maybe it was damaged and someone forgot to, as they wrote that off the books, they probably forgot to deplete the inventory of the unit that was destroyed or had to be sent back to a manufacturer. So also sometimes they're just missing, could be in a wrong place. Most people that walk in a retailer don't want to purchase certain items and will put it in an area where it has nowhere where it needs to be. So instead of just giving it to your cashier saying, hey, this is a go back, could you make sure it gets back put on the store shelf? They'll just leave it anywhere. So a lot of places like clothing, if you see that there's a size that they don't have, you ask somebody specifically, they'll look in the computerized perpetual inventory system and says, hey, we got like 10. Okay, if you have 10 and there's nothing out on the store shelf and there's nothing in the back storeroom, it's probably somewhere in the store. It's just crazy with what people do. So sometimes it makes it very difficult to find. That's why periodic inventory counting is so important. Most companies will do it by the end of the month. If you're Lowe's or Home Depot, they actually do for any of their bulk nuts and bolts and other items that you can buy loose directly. They will actually weigh it and do a catch weight, but they'll weigh it when they're starting and when they're ending their shift, just to try to keep as accurate inventory levels as much as possible, because those inventory levels really do affect their overall financial budget, specifically because you're talking about the inventory that they paid for, which is their cost of goods sold, versus the sales revenue that they received. So, they're missing part of that profit margin, especially if product isn't necessarily there, but they paid for it. So it's going to be written off as a loss. The last part is just-in-time inventory. Most of our production facilities, if you're working in an industry where it's fresh meat, fresh produce, fresh, anything, baked bread, dairy, bakery specifically as well, they usually just want to produce on the day. On the day production is one of the hardest things in the world to do, especially if your production facility is limited on the capacity of the space and the throughput in which that it could use. So just-in-time inventory is also where some people just take the inventory right as soon as it's produced. But it's pretty much an industry-to-industry specific item. All right, now we're going to focus on the periodic. There's 2 types of periodic inventory counting that we're going to do specifically to cost it all out. One is called FIFO, first in, first out. The second one is called LIFO, last in, first out. That basically means for FIFO, it's for single selling good items. LIFO is when we're going to sell items in bulk, but we buy all the inventory loose. So we're going to give that a shot. All right, stay tuned.